It was the year 2021. Delta Airlines, one of the three largest passenger airlines in the world, employing some 90,000 staff worldwide and around 800 commercial aircraft and routes connecting every major market on Earth, reported a net loss of $280 million for the year. At the same time, FedEx reported net income of $5.2 billion, its highest profit in company history. U.S. reported $12.9 billion in net profit, a figure so large that it exceeded the combined profits of every major U.S. passenger airline in the prior decade. Atlas Air, a cargo carrier that most travelers have never heard of, saw its stock price triple between 2019 and 2021. Air freight rates on key transoceanic routes, which had averaged roughly $2.5 per kilogram for a decade, had surged to $8, $10, and in some cases $14 per kilogram. The companies that moved packages were generating margins that the companies moving people had never achieved at any point in commercial aviation history. Nobody in the industry had predicted this. Most aviation analysts had spent years arguing that cargo airlines were structurally disadvantaged relative to passenger carriers, that belly freight on passenger aircraft was the economically superior model, that dedicated freighters were an anachronism, and that the future of air freight lay in integration with passenger networks rather than as standalone operations. 2021 showed that this entire framework was wrong. The question is not just what happened in 2021. The question is whether the pandemic revealed a permanent structural advantage in cargo that had been hidden by the economics of the passenger-cargo relationship for decades. To understand what 2021 exposed, you need to understand what belly cargo is and how it was distorting the economics of air freight before the pandemic. When a passenger airline operates a wide-body aircraft on a long-haul route, an AI Wushu from Singapore to Frankfurt, at CCC from Los Angeles to Tokyo, the aircraft's belly cargo hold is typically half full of freight that shippers have paid to transport. This freight is a secondary revenue stream for the passenger airline. The aircraft was going to fly anyway to move the passengers. The fuel was going to be burned anyway. The crew was going to be paid anyway. Any freight revenue the airline collects from the belly hold is incremental. It doesn't need to cover the full cost of the flight because the passengers already cover that. The airline can price belly cargo at rates that simply need to exceed the marginal cost of handling the freight, which is relatively low. Dedicated cargo airlines, FedEx, UPS, Atlas Air, Cargolex do not have this option. Every dollar of revenue they collect must cover the full cost of the flight, covering the cost of fuel, plus the cost of crew, plus the cost of maintenance, the aircraft ownership cost itself, plus the ground handling infrastructure, and finally, the profit margin. They are competing for freight against belly cargo operators that structurally can undercut them because belly cargo pricing is built on a marginal cost basis rather than a full cost basis. This has been the core challenge for dedicated freighter operators for 30 years, competing against freight that is essentially hitchhiking on passenger aircraft at prices that don't reflect the true cost of running an aircraft. COVID-19 eliminated this competitive distortion overnight. In March 2020, when governments closed borders and lockdowns grounded international travel, all passenger airlines stopped flying, not just reduced their flying. They had simply stopped flying entirely. The belly cargo capacity that had been suppressing air freight rates across all major trade lanes simply vanished. Passenger wide bodies that had been carrying 20 tons of cargo in their holds, flying alongside up to 300 passengers, were suddenly on the ground. Engines cold left their cabins, largely empty, and the freight that those holds had been moving still needed urgently to move. The demand for air freight did not fall with the passenger aircraft. If anything, the demand surged. Supply chains that had relied on slow ocean freight from Asian manufacturers to Western consumers were disrupted. Personal protective equipment, masks, gloves, gowns needed to move from Chinese factories to hospitals in Europe and North America at air freight speeds because sea freight takes 30 days, and a hospital running out of PPE cannot wait 30 days, including various critical pharmaceutical products, sophisticated consumer electronics products and goods, huge volumes of e-commerce inventory, and medical equipment all required air transport. The market demand was clearly there. The belly cargo capacity was not. FedEx, UPS, Atlas Air, Cargolux, and every other dedicated freighter operator found themselves in the extraordinary position of being the only functioning solution to a crisis in global supply chain logistics. Freight rates, which had been compressed by belly cargo competition for years, were suddenly set entirely by supply and demand for dedicated freighter capacity. The supply was fixed. You cannot build a freighter fleet in 6 months. The demand was actively surging. The rates that the market set reflected this reality with precision. The speed and scale of the rate increase was stunning. Air cargo rates from China to North America, which had averaged $2.5 per kilogram in 2019, reached $14 per kilogram by mid-2021, representing a nearly six-fold increase. Rates from China to Europe followed similar trajectories. For a freighter operator carrying 90 tons of payload across the Pacific, the revenue per flight went from approximately $225,000 to over $1.2 million per flight. The aircraft, the crew, and the fuel were the same costs. The revenue was 6 times higher. The margin expansion was extraordinary. The profitability generated by these rates was not evenly distributed. Airlines like FedEx and UPS, which owned their own large freighter fleets and had invested decades in building global networks and their dedicated ground infrastructure, captured by far the most. Their cost structures were fixed because their infrastructure was already ready, and the only change was the revenue per flight. Their profits reflected the leverage that comes from high fixed costs when pricing power suddenly shifts in your favor. Passenger airlines that tried to participate in the windfall by flying passenger aircraft in cargo-only configurations with boxes strapped to seats captured some of the benefit, but at the cost of significant operational disruption and the passenger service suspension. The longer-term question was always whether the rate environment was temporary or structural. Optimists for the cargo sector argued that e-commerce growth represented a permanent shift in the demand for air freight, that consumers who had discovered the convenience of online shopping during lockdowns would maintain elevated ordering rates afterward, sustaining freight volumes above the pre-pandemic baseline indefinitely. The data has been partially supportive of this argument. Air freight volumes in 2022 and 2023, while below the peak of 2021, remained above pre-pandemic levels on most trade lanes. E-commerce growth has continued globally, with Asian exporters, particularly from China, shipping increasing volumes of small package air freight directly to Western end consumers through channels like Shine, Temu, and Alibaba. The de minimis import threshold in the United States, which had allowed packages valued under $800 to enter duty-free, was generating an enormous additional air freight demand, specifically for small, high-value goods shipped directly from Chinese factories to American consumers. But the rate environment did not sustain itself as passenger aircraft returned to service through 2022 and belly cargo capacity was restored. The structural relationship between passenger networks and freight rates eventually reasserted itself again afterward. Rates from Asia to North America fell from their 2021 peaks to levels that, while still above pre-pandemic averages, no longer generated the extraordinary margins that had made 2021 so profitable. Specifically for dedicated freighter operators, what the pandemic revealed and what the subsequent normalization has not reversed is the structural reality that had always been true, but had been masked by the belly cargo subsidy. Dedicated cargo airlines, when competing without the belly freight subsidy, can generate margins that are genuinely superior to passenger airline margins. The passenger airline business is structurally difficult and notably high fixed costs, enormous labor and fuel exposure, extreme sensitivity to demand shocks, and fierce competition that limits pricing power in most markets. Cargo is structurally more insulated, where contracts are often longer term, where pricing is more transparent, and the demand for fast, reliable delivery is less elastic than the demand for passenger travel. The structural shift in e-commerce demand deserves particular attention because it represents a permanent change to the underlying demand profile for air cargo rather than a temporary pandemic anomaly. Between 2019 and 2023, global e-commerce volumes grew at a compound annual rate of approximately 18%. The fastest growing component of that growth was cross-border e-commerce. Purchases made from international sellers that require air freight to complete delivery within consumer expectations. Chinese e-commerce platforms, in particular, Alibaba's AliExpress, Shine, and Temu, generated an enormous wave of small parcel air freight demand from manufacturing hubs in Guangdong and Zhejiang to consumers in Europe and North America. This demand is not cyclical. Consumers who have experienced two-week delivery from Chinese platforms on price points that domestic retailers cannot match are not returning to buying domestically at higher prices. The air freight demand that supports cross-border e-commerce is structural, meaning it will grow with e-commerce penetration rather than cycling with the broader economy. This structural shift has forced the major integrators, FedEx, UPS, and DHL, to rethink their freight network capacity. FedEx accelerated its investment in freighter capacity through 2022 and 2023, placing orders for additional Boeing 767 freighters to handle e-commerce volumes on transatlantic and transpacific routes. DHL similarly expanded its European air network. UPS made specific investments in its Asia to Europe freight corridor. The cargo network build-outs that these companies were undertaking were not responses to the 2021 rate spike. They were responses to the underlying demand growth that the 2021 spike had made unmistakably visible. The passenger airlines' response to the cargo profitability revelation has been instructive. Several major carriers, Lufthansa, Emirates, Air France, KLM, and Korean Air among them, accelerated investment in their cargo subsidiaries following 2021, converting additional aircraft to freighter configuration, adding fully dedicated freighter capacity, and renegotiating their cargo pricing structures to capture more of the market rate, rather than pricing cargo as a commodity add-on to passenger operations. Lufthansa Cargo, already one of the world's largest dedicated cargo operators, publicly committed to expanding its freighter fleet. Korean Air made a strategic decision to maintain a significant proportion of its full freighter fleet, even as passenger travel recovered, recognizing that the cargo margins it had accessed during the pandemic were available structurally rather than cyclically. Qatar Airways, which had always run a significant cargo operation in parallel with its premium passenger business, used the 2021 surge to further establish Qatar Airways Cargo as one of the top 5 global cargo carriers by volume. The passenger airlines that moved quickly to capture the structural cargo opportunity will be better positioned in the next demand surge than the ones that treated 2021 as an anomaly to be waited out. The pandemic did not make cargo airlines more profitable than passenger airlines. It temporarily removed the distortion that had made cargo airlines look less profitable than they actually had been before, while simultaneously eliminating the belly freight supply that had been keeping their rates artificially compressed. What 2021 showed was not an anomaly. It was the underlying economics of air cargo, fully visible for the first time, without a passenger network generating artificial competition. The question now is not whether cargo airlines deserved to be more profitable, and indeed, they certainly did. The question is how long it takes the passenger airline industry to recognize that they have been subsidizing their competitors' supply chains for the next 30 years.